Hi, welcome to Let's Talk Bonds, the podcast from INR Bonds. I'm Arjun Patsati. To all our followers, we are making the podcast a fortnightly one, largely because we also have the newsletter Search for Eels that is also turning into a fortnightly one. So a second fortnight, you every fortnight you'll get the Let's Talk Bonds podcast. So without further ado, let's continue with today's topic. And the topic today is that we the investors can now look forward to investing in very good issuers like REC. REC is a PSU bond, which is also part of the Bharat Bond ETF, and they have issued rupees 1 lakh bond, face value bond, 3 years bond and 10-year bond at over 7.5% levels, 7.56% and 7.6% plus levels. Now, this enables retail investors to invest as low as rupees 1 lakh or higher in PSU bonds like REC, and this gives them a wider option to diversify their investments in fixed income. This is a very good option for investors who are looking for safety, high liquidity. REC can be sold at any point of time in the market. And because it is a PSU bond and it is well accepted in the market, and it is clearly AAA government owned, so the credit risk is almost zero. There is credit risk, but given that it's one of the uh, main entities of the government of India, there's always support from the government, and hence credit risk is very low for this bond. More issuers like RAC are going to come to issue 1 lakh face value bond, and this is going to open a huge variety of choice to investors through online bond platforms like INR bonds, where we will enable investors to invest in such bonds. Those investors who have been following INR bonds anyway have been seeing a quick invest by INR bonds app, where we curate bonds for issue investors through the best information and our own proprietary risk score. And they have with the most seamless of in-app investment process. So download the app now. And financial advisors can log into a partner portal for the best bonds to select for their clients and give them the best risk-adjusted returns for their clients' portfolio and fixed income. And financial advisors can grow their fixed income assets by becoming a partner with INR bonds. So log into INR bonds partner portal now. Back to private placements. Again, all 1 lakh face value bonds are coming in. Now, for those of you coming in late, SEBI has allowed private placements of a face value to come down to rupees 1 lakh. It was rupees 10 lakhs earlier, and that prevented a lot of investors from it getting good bonds to invest in, largely because of the fact that 10 lakhs was too high a amount to invest. Now, 1 lakh is a much smaller amount to invest, and many investors can invest in such diversified bonds. If they want very high safety bonds like REC, they can get. They can also get other bonds like if they, for example, John Deere, they issued, it's a AAA company, they issued 1 year bond at 8%, again, 1 lakh bond. Kotak Mahindra Prime has issued bonds, which is maturing in 2 and 3 years at 7.88 and 7.9% respectively. And if you go down the rating scale, Avance Financial, an education lender, it has issued 3 year bonds at 9.25%. All these are again 1 lakh face value bonds. Investors can even create their own portfolios through the bonds. Hence, from February, when exchanges start to allow platforms to transact in less than 1 lakhs through the through their clearing systems, the investors will have a much wider variety of choice, and this is really going to help the markets. And especially if more issuers like RAC, NABARD, and many others come in to invest to issue bonds for retail investors with 1 lakh face value, it's going to really open the bond market. So back to let's talk bonds in terms of what are the markets what are saying. They're not much. 10-year and 5-year has been range bound, and just have been range bound in the 712, 715 to 730 levels. Waiting for the budget. Inflation came in below 6% for December, but it really doesn't say too much because global inflation too is still high, and expectations are more rate hikes. Still a lot of uncertainty, volatility in equity markets. Uh, Again, there's been the short end rates, the it's what in technically what is called a very flat yield curve, where 1 to 10 year is just in a range of around 50 basis points. So it's better to invest in short term, very short maturity bonds, 3 months, 6 months, 1 year, 2 year, or maximum 3 years, and keep rolling over the maturities till the uncertainty passes. And good investors like REC, good issuers like REC should be invested. Can be easily invested by risk-averse investors and earn higher returns on their investments along with very strong liquidity. So they can either pledge these bonds for, or they can even sell the bonds in the market without any problem. Thank you very much for listening into our podcast. Let's talk bonds. As I reiterate, it's fortnightly now, and I'll connect back to you next fortnight. And please follow us on all podcast channels.